Welcome to the Finance Yahoo News channel, where we bring you the latest updates and insights on the world of finance. From stock market trends to personal finance tips, we've got you covered. Stay tuned for our expert analysis and interviews with industry leaders. Let's dive into the world of finance together. Despite the challenges faced by the industry, including low interest rates and increased competition from fintech startups, these banks have managed to maintain their dominance and even increase their profits. This is in stark contrast to smaller regional banks, which have struggled to keep up with the changing landscape of the financial industry. Many of these banks have been forced to merge or close their doors altogether, unable to compete with the big banks' resources and technological advancements. The success of the big banks can be attributed to a number of factors, including their ability to diversify their revenue streams and invest in new technologies. They have also been able to weather the storm of the pandemic, thanks in part to government stimulus programs and a strong housing market. However, it is important to note that the success of these banks does not necessarily translate to success for the broader economy. The concentration of power in the hands of a few large institutions can lead to systemic risks and limit competition, ultimately harming consumers and small businesses. Overall, the strong earnings reports from the big banks are a testament to their ability to adapt and thrive in a rapidly changing industry. However, it is important to consider the potential downsides of such concentration of power and to ensure that competition and innovation are not stifled in the process. How can we balance the benefits of the big banks' ability to adapt and thrive with the potential risks of concentration of power and limited competition in order to ensure a healthy and innovative financial industry that benefits both consumers and small businesses? The impressive earnings of big banks have left investors satisfied and analysts questioning the existence of a crisis. Despite the challenges faced by the banking industry since the 2008 financial crisis, JPMorgan Chase, Wells Fargo, Citigroup, and PNC all reported surging revenue and profits. Their top executives offered multiple assurances that the worst was over, with JPMorgan CFO Jeremy Barnum stating that things were looking better now, and Citigroup CEO Jane Fraser adding that our banking system as a whole is very strong. While it is certainly encouraging to see the banking industry performing well, it is important to approach these claims with a healthy dose of skepticism. After all, the 2008 financial crisis was caused in part by overconfidence and complacency within the banking industry. It is crucial that we continue to monitor the performance of these banks and hold them accountable for any missteps or unethical behavior. Furthermore, it is worth noting that not all banks are faring as well as the ones mentioned in the article. As the article briefly mentions, regulators recently seized some regional lenders and panic spread across the financial system in March. This serves as a reminder that the banking industry is not immune to crises and that we must remain vigilant in our oversight. In conclusion, while the impressive performance of some of the largest U.S. lenders is certainly cause for optimism, we must approach their claims with a critical eye and continue to monitor the industry as a whole. As the saying goes, trust but verify. How can we ensure that the banking industry remains accountable and vigilant in the face of potential crises? Given the overconfidence and complacency that contributed to the 2008 financial crisis, however, not all economic sectors are experiencing the same level of success, as commercial real estate in New York City continues to face challenges. The pandemic has caused a shift in the way people work and shop, leading to a decline in demand for office and retail space. While the residential rental market has bounced back, the retail and office markets have remained slack. This has put a strain on the New York City economy, with commercial rents in Manhattan down significantly from pre-pandemic levels. The report highlights that while workers are coming into the office more now, they're not doing it in great enough numbers to help lift up all the companies that once supported these workers. This has impaired employment in those parts of the service sector. The report also notes that while areas that surround the city are largely recovered on the jobs front, the city still has about a 1% shortfall in workers relative to before the pandemic. The challenges faced by commercial real estate are further exacerbated by the troubles now hitting smaller banks in the wake of the failure of Silicon Valley Bank last month. These firms may be less able to lend in the current environment and may be more exposed to defaults from commercial property borrowers. It is unclear when or if the commercial real estate sector will return to its prior strength. While employees are coming into the office more now, they're not doing it in great enough numbers to help lift up all the companies that once supported these workers. This has impaired employment in those parts of the service sector. The report notes that when workers are in the office, the firm needs all the space it's leased, with empty rooms on the other days. In conclusion, the report by the New York Fed highlights the ongoing stress in the commercial real estate sector in New York City. The pandemic has caused a shift in the way people work and shop, leading to a decline in demand for office and retail space. While the residential rental market has bounced back, the retail and office markets have remained slack. The challenges faced by commercial real estate are further exacerbated by the troubles now hitting smaller banks in the wake of the failure of Silicon Valley Bank last month. It is unclear when or if the commercial real estate sector will return to its prior strength. How will the ongoing stress in the commercial real estate sector in New York City impact the overall economy and job market in the long term? As New York City struggles with the impact of commercial real estate woes, another economic concern has emerged with the recent cracks in grocery prices, particularly for eggs. The Bureau of Labor Statistics' March Consumer Price Index shows that the cost of groceries is up 8.4% compared to March 2022. This is a concerning trend, especially for low-income households who spend a larger portion of their income on food. It's interesting to see how the pandemic has affected food prices. Last year, we saw a surge in demand for groceries as people stocked up on essentials during lockdowns. This led to supply chain disruptions and shortages, which drove up prices. Now, as the world slowly recovers from the pandemic, we're seeing a drop in demand for groceries, which may explain the recent dip in prices. However, it's important to note that food inflation remains higher compared to overall inflation. While overall inflation was up 5.0% year-over-year, food prices increased by 8.4%. This suggests that food prices are more sensitive to supply and demand shocks compared to other goods and services. It's also worth noting that the recent drop in grocery prices may not be sustainable in the long run. As the world recovers from the pandemic, we may see a resurgence in demand for groceries, which could drive up prices once again. Additionally, climate change and other factors may continue to disrupt food supply chains, which could lead to further price increases. Overall, while the recent drop in grocery prices may be good news for consumers, it's important to remain vigilant and monitor food prices closely. As the pandemic continues to affect the global economy, we may see further fluctuations in food prices, which could have significant implications for households and businesses alike. How can governments and businesses work together to ensure that low-income households have access to affordable and nutritious food, especially in the face of supply chain disruptions and climate change? As inflation continues to impact the cost of everyday items, such as groceries, it's becoming increasingly difficult for even high-earning individuals to afford certain expenses, including housing. This situation is not unique to them, as many high earners are still renting instead of owning. The median household income in Los Angeles is $69,778, and the average home value is $891,820, making it difficult for anyone making less than $200,000 to afford a home. The article also points out the structural barriers that prevent millennials from entering the homeownership market, which is making incumbent homeowners richer while immiserating an entire generation of people. The lack of affordable housing is not just a problem for millennials, but also for communities of color and lower-income communities that have historically faced those same barriers. The article suggests that there was a time when Los Angeles built to accommodate new demand, but that is no longer the case. The lack of new construction has led to a shortage of affordable housing, and the situation is unlikely to change anytime soon. Overall, the article highlights the need for policymakers to address the structural barriers that prevent people from owning homes. It also underscores the importance of building more affordable housing to accommodate new demand and ensure that everyone has access to safe and affordable housing. How can policymakers address the issue of structural barriers that prevent millennials, communities of color, and lower-income communities from entering the homeownership market? And what steps can be taken to increase the availability of affordable housing in cities like Los Angeles? Despite their high income, the professional couple's struggle to afford a home in Los Angeles highlights the ongoing challenges of the housing market, which is just one factor impacting the stock market news today. Bank stocks are rallying, while tech stocks are under pressure. This comes after a rush of earnings reports from some of America's biggest financial institutions, including JPMorgan, Wells Fargo, PNC Financial, and Citi. The S&P 500 futures are down slightly, while Dow futures are up slightly, and NASDAQ futures are down by 0.5%. This mixed performance in the futures market is not surprising given the contrasting results from the banks and tech companies. The banks have reported strong earnings, with JPMorgan beating expectations and Wells Fargo reporting a profit after a year of losses. This has led to a rally in bank stocks, as investors are optimistic about the economic recovery and the potential for higher interest rates. On the other hand, tech stocks are under pressure as investors are concerned about the high valuations and potential regulatory risks. This comes after a year of strong performance for tech stocks as the pandemic accelerated the shift to digital and remote work. However, with the economy reopening and the prospect of higher interest rates, investors are rotating out of tech and into other sectors. Overall, this mixed performance in the futures market reflects the ongoing uncertainty and volatility in the stock market. While some sectors are performing well, others are facing headwinds and challenges. As always, investors need to stay alert and informed and be prepared for a range of outcomes. What factors are contributing to the shift in investor sentiment from tech stocks to bank stocks, and what implications does this have for the broader economy and financial markets? Moving on from the mixed performance of stock futures, another interesting development in the world of finance is the increasing demand for Russian oil from China and India. This development is a result of the Western sanctions imposed on Russia, which have forced the country to look for alternative markets for its oil exports. China and India have stepped in to fill the gap left by Europe, which used to be the largest market for Russian oil. The fact that China and India now account for roughly 90% of Russia's seaborne crude exports is a testament to the growing economic power of these two countries. It also highlights the importance of diversifying oil supplies for energy security. The reliance on a single supplier can be risky, as demonstrated by the recent disruption of oil supplies from the Middle East due to geopolitical tensions. The shift in the global oil market towards Asia is not surprising, given the region's growing demand for energy. China and India are the world's largest and third largest oil importers, respectively, and their demand is expected to continue to grow in the coming years. This presents an opportunity for Russia to expand its market share in Asia and reduce its dependence on Europe. However, the Western sanctions on Russia have not been without consequences. The drop in oil prices has led to a decline in Russia's revenue from energy exports, which is down about 43% compared to the same time last year, according to the International Energy Agency. This highlights the need for Russia to diversify its economy and reduce its dependence on oil exports. In conclusion, the news that China and India are buying so much Russian oil that Moscow is now selling more crude than it was before invading Ukraine is a reflection of the changing dynamics in the global oil market. It highlights the importance of diversifying oil supplies for energy security and presents an opportunity for Russia to expand its market share in Asia. However, the Western sanctions on Russia have not been without consequences, and Russia needs to diversify its economy to reduce its dependence on oil exports. How can Russia diversify its economy to reduce its dependence on oil exports, and what challenges will it face in doing so? Thank you so much for watching. I hope you enjoyed the content and found it informative or entertaining. If you did, please consider liking this video and subscribing to our channel for more great content in the future. Your support means the world to us and helps us continue to create and share our passion with the world. Thank you again, and we'll see you in the next video.